Hi everyone, David Maley here, and today I'm going to show you how to do some really cool stuff. We're going to use Arimas and custom Arimas to predict the stock market, and especially for Exxon Mobil Corporation. It's one of the bigger companies out there. So you can see here I have a page off Yahoo Finance where I've shown the Exxon Mobil share price since the beginning that they have it here. So we got from 1962 onward, and you can see right now you're at 51.44 because we had this big, huge drop in the last week in the financial sector, well, in all sectors, and it's due to the coronavirus, right? So this coronavirus is supposed to be really bad. It's going to be a pandemic. Everybody's panicking. So that if you look at this, Exxon Mobil is trading at the actual same price it did back in 2005 to 2004. Now that doesn't take into account dividends and things like that, but still, it's really hit it hard in the past week. So it's become a great buy, as you'll hear on TV. But is it really a great buy? And where's it going to go in the short term and longer term? So I'm going to show you how to do that in R. So what we're going to do is I'm going to show you exactly all the code to figure out, is it a good buy? Would it be a good buy? Now keep in mind, this is using Arimas and auto Arimas. I'm not giving you financial advice. Now I'm not telling you to buy this stock. You need to go and figure that out for yourself. If you need advice, go and find a financial advisor. I am not a financial advisor. I'm a data scientist. I'm just going to show you how we would go about using Arimas, custom Arimas, and auto Arimas to figure this all out. So let's go in here. Let me show you the code I'm going to use. Okay. And so first we're going to show the libraries. Obviously in R we got to load in libraries. If you don't load them in, you've got to do an awful lot of custom coding. Who wants to do that? So let's load these in right here. So you've got XTS, forecast, time series, T series, and quant mod. If you don't have them, use this little line right here called install.packages time series, just like that, or whichever one you're using. Make sure you spell them correctly. Time series is a lowercase t and uppercase s. If you don't do that, it won't find it. R is very anal retentive. It needs to find exactly the right spelling, if it's capital or not, so on, underscores, whatever. All right, so once we do that, as I told you, we're going to pull this from Yahoo Finance. Yahoo Finance makes all of their data available since, I'm not sure how far back it goes. It shows 1962, but I'm not sure if that's for every stock traded out there or the ones that are available. So anyway, with XOM, we're not going to pull back all the way to 1962. That's a lot of data. So what I've got here is I am pulling right here from 1995, January 1st, to 2020, 301, which is obviously March 1st, which is today. Okay, and so I'm pulling that all back. I use the get symbols, okay, function of, in this case, XOM. If I spell it incorrectly, I put something else in, I'll pull a different stock in. I don't want to do that right now. So I pull that in, and then I also, right after that comes in, I do a class on it. I want to make sure the data came in correctly. You're going to see that it is class of XTS zoo. That's what it's going to say. Okay, and that's where we use this library XTS package to work with it. Okay, make sure that it says that. Then what you want to do next is we want to make sure when that data comes back, it's not just the closing price. It gives the beginning price, the closing price, highs, lows, all kinds of stuff, right? So you'll see here next to this, I have written down the first value is the open, second is the high, third is the low, 4 is the close, 5 is the volume, and then there's also some adjusted prices, stuff like that. We don't want all those. We just want number 4, the close, because who cares what the high was if it went back down? I don't care what the high was. Yes, if I was looking at volatility, like you might actually want volatility now as an extra component, but right now for this purpose of this, I'm not going to do that. Okay, the coronavirus, believe me, it's going to cause a lot of volatility going the next couple of weeks or even months, depending on how this virus works out. If it becomes a full pandemic, how widespread it becomes, or if it dies out. Sometimes that happens too. I hope that's the case, that it dies out, because we don't need any more people getting sick and so on. And if you're sick from it, I wish you the best. I hope you get get well soon. So here, this is the code we're going to use to get that closing price. So remember, I told you it was number 4. So right here, I'm going to use XOM. I'm just calling it this. So I'm calling it XOM close prices, and I'm putting in there XOM, which is from this part 4, right? The 4th component, which is the close. Then once I've done that, I want to plot this data. I want to see what it looks like. And what's important is I use 1995 on purpose because it gives me two recessions. The recession right after, right during 9/11, that time frame, 2000, 2001. And then the other deep recession was the deepest recession in current history, which was 2008 to 2009. Recovery didn't happen until late in 2011, 2012 with that. Some areas it still hasn't fully recovered yet, depending on where you are. Like Wisconsin and places like that. So that was a deep recession. So we want to include that in there to give us a more realistic prediction here. So what we're going to do is we're going to plot this. So if I take this, right, and I hit this, and I hit Control and Enter, right? Now that doesn't look good because I have to go, let me do this. Let me add a piece of code here. So right below it, see this par m fro right here? What this does, it divides up the screen. I've already done that for some graphs we do down below. So 1, 1 means one graph. 1, 2 means two graphs side by side. 2, 1 means two graphs one above the other. We're just going to use 1, 1. So let's reset our graph screen so you can see this better. And see how I did that? So now when I do that, you're not going to see it yet, but it says it right down here, what I just did, 1, 1. And then I'm going to go back and rerun this plot again. Now see how it goes and covers the whole screen? So let's bring this out a little bit so you can see it better. Okay, so this shows you from 1995, the beginning, all the way through to now. And you can see the little route at the end here. See how bad that drop was of the last week? It went from, it was averaging somewhere around, 70 to 68, 70 at that point. Still was coming down a little bit, but it went bam down to, 48, 50 right in that range. So it includes all of that in there. It includes, here you can see the recession, and you see the other recession right here and here. Okay, and then there was a correction right here. So let's open this up. We've got the plot of it. I showed you how to reset the plot, so it's 1 per screen. Now we're going to go back to having 2 per screen, right? So I said 1, 2, PAR, the PAR function, M, F row, then 1, 2. So let's do that. And then next, what I want to do is I want to show you two things. I want to show you the ACF and the PACF. And the reason being is the PACF gives me the P value, the ACF gives me the Q value. So when I'm looking at auto Arimas, I want a P value, I want a Q value, and then there's a D value. So it's P, D, Q, right? D is the differencing. So watch this. So what we're going to do is we're going to take both these functions right here. Let's get that in parenthesis there. For ACF and PACF. And remember, we called it what? XOM close prices, right? So we're doing that, and then we're just calling it ACF and PACF. It's just PACF and ACF functions. Pretty simple to run here. We run them both, and there they are. Now, what you want to do immediately here is you look at this. Obviously, this one's running on like a reverse compound. We know that it starts at 1, right? And this one clearly identifies that 1 with a little bit of 2 and 3. So we know from this, the PACF gives us the P value, which is 1. Okay, so next what we want to do is go to the next, which is to print the ADF test, right? So let's do this if we wanted to print it. And that shows you down below here exactly what we're looking at. So our P value, it gives you the P value, right? It gives you the lag order, 18, and the Dickey-Fuller test, okay? And it's stationary, which is good to know. So what we want to do next is look at our auto Arima, right? So let's do this. So auto Arima is a very simple function. It's not a custom Arima. So you just use auto.arima. It tries to use the best fit that the computer can figure out for your data. Of the XOM closed prices, seasonal equals false, right? So if I hit Control and Enter on that, there we go. And it gives me a 0, 1, 2. See right there, right at the top, 0, 1, 2. And it also gives me the AIC and BIC values. Okay, so I put them over here. But the most important thing is the 0, 1, 2 from that, right? So we know what that is, but what did we get? Our PACF says 1. Which one is 1? Remember, it's PDQ. So the first value should be a 1. But hold on, the auto Arima says we're going to use 0, 1, 2. So we're going to put that into a fit. We're going to use this later on. We're going to use 4 different fits, right? So I'm going to have the first one be auto Arima, then I'm going to have 2 custom Arimas, and then I'm going to follow up with the generic default Arima, which you'll see a lot of business applications use. Click, Sense, let's see, Power BI, and what was the other one? Alteryx and some others use is called 111. Right, that's the standard default, and we'll use that as the 4th one to compare it. So we got 4 different things to compare with. So fit A is going to be the first one. It's going to be our auto Arima, right? So I'm putting at fit A of the XOM closed prices, seasonal equals false. So if I do this, then I'm going to do a display on it because I want to see how does it look, right? So if I hit display, I've already run these. These will take a little long, and the reason being I'm not going to run them right now because they'll take a few minutes, and you're talking about all the data points from 1995 to 2020. Okay, so I'm not going to run that part right now. I've already run that, but let's show you this anyway, the TS display. There you go. So when you're done, you'll have this, and this will show you in the Arima you have a lot of lags. Lags are areas where there's out of bounds, there's outliers. It's not necessarily going to be as super accurate as you would like, and that's fine. Okay, that's the Arima at 012. Okay, and then what we do is you can run it right here to do the same thing. But what we want to do is now I want to start with the custom Arima. So you got fit A. Now we're going to have fit B. Fit B, remember I told you when we did the PACF and ACF, we had a value of 1 for the P. So instead of having 0, 1, 2, we're going to have 1, 1. And then remember when we did the PACF and the ACF and the other tests, we found that the last lag, like you see right here, is at 21. So right here, see it's PACF based on the Arima. So see how there's a lag here, lag here, lag here, lag here, lag here, lag here. I want to use the last lag. If I use the first lag, I'm still going to have lags after that. It's still going to be inaccurate. I want to go for this period up to, I've got 40, maybe 42 in here is the end of it. So I want to use the last lag, which is 21. That's where this one comes from. See that? So I've got 1, because the p-value should be 1, comma, 21. Okay, so that's what I'm going to use for B. And then I can do the same thing. I can display it again for the new one. This is the custom Arima. Now look at the difference. All of them are within bounds. See how I did that? If I used an earlier lag, there would be some out of bounds. So we got a better fit. Okay, I guess it's going to be more accurate. Okay, then fit C, what I'm doing is we're going to use a different one. Now in this case we just left it at 21. I don't know why we would do that. That would be the exact same thing. So let's use an earlier lag or a later lag. We could say let's use a difference of 2 or 3. Well in this case we actually, you know what, we did use difference. I'm losing my mind here. So we did use a difference of 2 and we left the lag at the same. So that's true. So see how it went from 1, 1, 21 to 1, 2, 21. Okay, so let's run this. I'm not going to run the whole thing, but I'm going to run the display on it. Because I've already run it, and then show you the difference here. So let's show you. It's still all within bounds. You got one that's touching right there, but that's fine. That's with the difference of 2. Okay. Now differencing is going to make it a little bit less accurate. So you got to be careful of that. You don't want to use it if you don't have to. So right now our 1, 1, 2, 1 is probably going to be our most accurate, but let's just hold on to see. And then remember I was going to show you the last one was going to be 1, 1, 1, right? The default. That's exactly what this is. So fit D right here shows you the 1, 1, the order, same thing, all the lag max is 40, right? So it actually cuts off at like 42, but it'll show you up to 40. And so if I show you on the 1, 1, 1, let's show you what the display looks like on that. Control Enter. And by the way, again, if you don't know, I'm using RStudio here to show you all this. See how all these points are out of bounds in 21? The 1, 1, 1 looks so much like the 0, 1, 2. They're very they're not as accurate, but we'll show you that again in a minute here. So now that we have these 4 points, so these 4 fits, right? So you got fit A, fit B, fit C, and fit D. Remember, fit A is a 0, 1, 2, the Arima. Fit B and C are our custom Arimas. Fit B is with 1, 1, 2, 1, which this should be our most accurate. We also have fit C, which has a difference of 2. So we got 1, 2, 21, and then we got fit D, which is the default, de facto standard of 1, 1, 1. Okay, so we got all 4 of those, and what we're going to do is we're going to first plot it for 100 days, right? So let's see, what would the stock market do based on these 4 different Arima models for the next 100 days? So let's do this. Let's take this whole area, term of 100, and we're going to use all those fits. And let's see what it does. There we go. Now by C, remember we showed you this par mfro equals C 2, 2. Before we did it with 1, 1, resets this to be 1 graph. 1, 2 gives you 2 graphs. 2, 2 gives you 4. Now you can barely see, it's here, but you can barely see the forecast here. that it's doing. So let's open this up a little bit, make it a little bit bigger. You can see it. You can see that they're basically almost a straight line. There's a little bit of upward movement in the 1121, a little bit in the 1221, and basically it's straight in the 111 and the 012. Now, I'm going to tell you right now, your most accurate are going to be these two, and they're telling you a little bit of upward, which would hint at there's probably, since there was such a drop, there's going to be a bounce back. There is the end of every recession, every correction. There's always a bounce back, right? We just don't know when it's going to start or how long it's going to be. So these two are both indicating that. These two are indicating, yeah, maybe not. Maybe, but no one's indicating a further drop, okay, or not much of one. But that's for 100 days. Now, if we want to see it a little bit better, we can open that up to 300 days, 200 days, whatever. I'm going to do it in a minute. But let's test our accuracy first, right? So let's get the accuracy of each of these forecasts, right? So now this accuracy is built on the forecast based on 100 days. So it's not going to tell you the accuracy based on 300 days unless I do that. So where I put term equals 100, or I put 100 into the value term, and then I use that in each. You use forecast of that, and it goes to FCAS 1, FCAS 2, FCAS 3, FCAS 4. That's what the code is right here. You can see that. And then it plots each, right? So what I'm going to use now is just the accuracy function on each of these four. And what I'm looking for, watch, I'll show you this in a second. Let's hit that, is this thing called MAPE, right? So let's open up a little bit wider so you can really see it. Let's run it again so it shows it out here. Now, see this value called MAPE? These are all leading indicators, but MAPE is one of the most accurate of them. And what MAPE is, you take it from 100, right? So if it said 1, it would be 99. In this case, it's darn close to 1 for all these. It's 1.067, 1.068, 1.0666, and 1.068, right? So what that's telling you is when you subtract that from 100, your value is like 98.92, 98.93. Okay, so that's telling you what your accuracy for all these is very high. Okay, so you got 98.92%, 98.91%, 0.18%, 98.918%. They're all darn close to each other, so they're all very accurate. So next, what I want to do is I want to show you, well, what if we did a term of 50? What does that do? 50 days. We can do that right here. We just change the term value to 50, rerun that block of code. So I love using reusable code. And there you go. You can barely see it, but it looks like a little upward movement again, upward movement. So these two are bounced back, that's straight, and it looks straight. Okay, now let's go and open up. What if we wanted to look a little bit deeper? I want to look a little bit longer. I want to look at a year. So obviously a year has 356 days in it. So let's look at a year. All right, so if I take this, the same code, the only difference is the 356 I'm putting in there, right? We'll be able to see it a lot clearer here. Let's run that. There we go. Now we can see it a whole lot better, right? So let's open that up. And what we've got actually, whoa, look at this one. It goes actually down a little bit. It goes up, as we saw, but then it goes down. This one goes straight, this one goes straight, this one goes up a little bit, but then it goes straight. So what that's showing me is it's going to be a long, according to these auto Arimas and the custom Arimas that we just did, it's going to be what? A correction that takes a long time to heal, to come back from. So a correction like what we just went through last week, it was like we lost between 15, well, I'd say between 14% and 20% in most markets in value, right? So the entire year was wiped out of markets for 2020 of any gains. So what that tells you is it's going to take probably 3 to 4 months or longer to gain that back. And that's what the experts are saying. So, and this correctly shows that, you know, there's not any real bam, you know, high growth rate after it. It's going to, I mean, there might be some little pockets of that, but what you're seeing here is you got to see a 100-day value or forecast, a 50-day forecast, and a year forecast. Very quick, very easy. I showed you exactly how to pull the data from Yahoo Finance for it, and you can do this for any stock or ETF. You can do it for the Dow Jones Industrial Average if you want. SPY, I've got another video that shows you doing that. This one actually here, though, what's important right now is it shows you with the correction from last week that was caused by the coronavirus. primarily, and the global worries about the possible pandemic from that. So that's priced into these numbers now. So, but it gives you a good way to look at this, and it's a great way to learn data science and dive into these numbers and forecasting and stuff like that. And you can see it's not hard to do. It's actually pretty simple and pretty quick. I hope you found this interesting and entertaining and educational. Please take a moment to subscribe to my channel. Click the bell so you get notified whenever I put a new video like this out. And be sure and look at my channel at all the other videos I have out there. I have a lot of great videos and all kinds of stuff related to data science, data analytics, using Excel to its max, all kinds of stuff like that. It's great for you. Thanks for watching. Please have a great day.